Okay, let's unpack this. We are diving into a story that is, frankly, more about market psychology and financial engineering than it is about solid business fundamentals.
It really is.
On Friday, January 16, 2026, a tiny medical aesthetics company, Venus Concept ticker, VER, it performed an absolutely spectacular move. We're talking a spike of over 400% in pre-market trading.
Just unbelievable numbers. The stock jumped from what, a close of $1.43 to somewhere around $5.57.
And it was all on the announcement that its senior lender, who is now its controlling shareholder, was initiating the process to take the company private, to delist the stock.
Right. And on the surface, it looks like a spectacular overnight windfall, doesn't it? A guaranteed payday for anyone who held shares when that news dropped.
Of course.
But for the disciplined investor, whenever you see that kind of extreme, instantaneous volatility in a microcap, and it's driven purely by a technical maneuver, a squeeze, a restructuring, the alarm bells just have to be ringing.
They have to be.
Is this a spectacular opportunity that everyone else missed? Or is it the textbook definition of a classic value trap? And that's what we're here to figure out. We are performing a forensic value analysis today to determine just that.
That's exactly our mission today. And the listener who shared these sources with us wanted us to strip away all that speculative noise and really understand the fundamental
To
reality.
get beneath the headline number.
Exactly. We have to look beyond the frenzy because the market price on the day of the surge, that 557-hour analysis, estimated that it was trading at a staggering, almost unimaginable 1,000% premium over the business's actual intrinsic value.
1,000%. Let that sink in. A premium driven purely by technical market speculation, not by any sudden improvement in revenue or profitability or asset value.
Love that.
So our goal is to anchor ourselves in the principles of rigorous value investing to understand how a business in such dire straits could command such an irrational price tag.
And the entire context for this dramatic movement, it's all found in a single document.
Yeah.
An SEC filing, specifically a Schedule 13DA filed by Mendrin Asset Management on January 15th, 2026.
And this wasn't just a minor update. This was the public acknowledgement that Mendrin, the company's longtime lender, had successfully used a series of strategic debt-to-equity conversions over the preceding months to gain absolute crushing control of the company.
We are talking about an effective 91% ownership stake.
91%. This changes the entire equation for VERO. We are no longer discussing a small public growth company seeking market validation. No. We are looking at a distressed asset that has officially been seized and is now being restructured by its senior creditor.
That's a great way to put it.
Mendrin is interested in debt recovery and cost reduction, and that fundamentally conflicts with the interests of the remaining public shareholders. So we need to dissect exactly how VERO reached this point of, total financial subjugation.
Absolutely. The devil is always in the details of the balance sheet. Part 1, Chapters 1 to 3, Business Management and Financials. Chapter 1, Business Understanding.
Okay, so let's start with the basics. What exactly is Venus Concept?
Right. It's a company operating within the global medical aesthetics market. They focus on what are called energy-based devices, or EBDs, and they also have some robotic systems. Their core business is selling this non-invasive equipment to places like medical spas, dermatologists, and aesthetic clinics all over the world.
And VERO's product portfolio is, fairly comprehensive for the sector. They have their flagship systems. On the body contouring and fat reduction side, you've got the Venus Bliss and the Venus Bliss Max.
Right, and these are marketed as combining a diode laser technology with their own proprietary tech, the MP technology.
And that MP is their attempt at a competitive edge, right? It stands for multipolar radio frequency and pulsed electromagnetic fields.
So the idea is that this combination simultaneously heats tissue to tighten skin and stimulate collagen, while also achieving some level of, circumference reduction. It's all about getting non-invasive results with minimal downtime.
Precisely. And beyond the body contouring, they have these multi-application platforms for skin rejuvenation, like the Venus Versa and the Venus Viva MD.
And those are used for what? Things like fractional skin resurfacing, wrinkle reduction.
Exactly, managing pigmentation. And they also offer standard industry equipment, like the Venus Velocity for high-speed hair removal. Essentially, they're trying to be a one-stop shop for a clinic that's looking to offer a wide array of non-surgical aesthetic services.
Okay, now here's a critical carve-out that affects the entire financial outlook, the hair restoration segment. This includes their high-tech robotic systems, the Ardise SI and NeoGraft. Why is this segment so crucial to the story?
It's crucial because it's the primary source of near-term liquidity VRO can point to. I mean, it's their only real lifeline. They announced the pending sale of that entire segment to a company called Meta Healthcare Group, or MHG, for $20 million in cash.
20 million. That's a massive injection of cash, especially when you consider their cash on hand was only about 5.9 million.
Oh, it's everything. If that sale closes, it is a crucial financial lifeline. But, and here is the critical complication we find in the source materials, as of early 2026, the closing has been delayed.
Delayed.
And not just delayed, VRO actually had to seek assistance from a Delaware court to compel the transaction.
Whoa. That is a significant red flag. I mean, it's one thing to announce a sale. It's another thing entirely to have to sue the buyer to compel them to close the deal.
It adds substantial uncertainty to the company's already fragile cash projections. It just makes our valuation based on realizable assets that much riskier.
You're right. The success of VERO's immediate survival, and therefore Madryn's ability to recover their debt, it really hinges heavily on receiving that $20 million. Any analysis of VERO just has to proceed with extreme caution regarding that delayed, compelled transaction.
Absolutely.
So let's pivot to the root cause of VERO's structural problems. This is the failed business model pivot. This explains why they ended up in debt to Madryn in the first place. They tried to be pioneers with a subscription model.
That's right. The initial strategy was, as you said, it was innovative marketing. The traditional model in this space, used by competitors like Candela or InMode, requires a physician or a clinic to shell out $100,000, maybe $200,000 upfront for a piece of equipment.
A huge capital outlay.
Huge. VERO tried to differentiate itself by offering a subscription model. A low upfront fee, easy installation, and then a monthly payment, say $2,000 a month over a 3-year contract.
That sounds like genius marketing. I mean, it lowers the barrier to entry so drastically. It allows smaller clinics that don't have $150,000 sitting in the bank to immediately start generating revenue with a Venus device.
Right.
So where was the fatal flaw?
The fatal flaw was entirely financial. It was capital intensity. VERO was essentially operating as a bank, a high-cost lender to customers who were, by definition, lower credit quality because they couldn't afford the upfront capital in the first place.
Right. So VERO had to bear the full manufacturing cost, deploy this super capital-intensive equipment, and then just wait 3 years to collect the full value.
And while they were waiting, they needed to fund the next batch of machines, which required them to take on significant debt themselves. That's where Madryn comes in.
I see.
So when interest rates were near zero, pre-2022, VERO's cost of borrowing to fund those installment plans was negligible. The model was, let's say, manageable, if risky. But as global central banks rapidly hiked interest rates from 2022 through 2025, VERO's cost of capital just exploded.
So they were funding debt-backed equipment sales into an aggressively rising rate environment.
Precisely. And this not only squeezed their margins, but it also exposed the weak credit quality of their customer base.
Because higher rates meant the clinics themselves were struggling more, right? That leads to defaults on those monthly subscription payments, increased bad debt expense, and just severe cash flow shortages for VERO.
They became a company defined by collecting on bad debt rather than selling new products. The model became financially impossible to sustain.
And that forced them into this painful strategic shift toward traditional cash sales in 2024 and 2025.
Yep. By the second quarter of 2025, something like 65% of their U.S. sales were traditional upfront cash system sales. This solved the immediate credit risk problem, but it created a massive competitive problem.
They traded a unique but structurally failed financial advantage for a generic spot in an intensely crowded market. Now they are competing head-to-head with giants like InMode, Candela, and Luminous.
Companies with massive cash reserves, established distribution networks, and deep pockets for marketing. And VERO cannot compete on those terms. The result of this painful shift from low-barrier financing to generic cash sales was severe and structural revenue contraction, which I know we'll quantify shortly.
And to compound this strategic weakness, there's the decision to pursue what they call strategic shrinkage. They're deliberately exiting unprofitable international markets to focus only on core territories.
Which it sounds rational on paper.
It does, but in a fixed-cost manufacturing business, it guarantees a shrinking revenue base.
It's a strategy often called shrink to glory, but it is notoriously difficult to execute. When you have expensive fixed assets like manufacturing facilities, R&D staff, corporate overhead, you need volume to gain operating leverage.
Right.
By guaranteeing a shrinking top line, they are spreading those fixed costs thinner and thinner, which further compresses their margins even before you factor in the interest costs. They are trying to become profitable by getting smaller while simultaneously dealing with that massive anchor of distressed debt.
It sounds like they are fighting for survival on three fronts: a broken original strategy, intense competition in their new model, and a shrinking sales base that just magnifies their fixed costs. It's a perfect storm.
It really is.
Chapter 2, Management Evaluation. So, when we conduct a value analysis, we have to look at the stewards of capital. Let's look at the CEO, Rajiv De Silva's background, because it provides really critical context for the corporate culture that VERO adopted.
De Silva has a pedigree that, while it looks impressive on paper, it immediately raises serious questions in value-invested circles. He came up through the pharmaceutical industry and is known specifically for his past associations with companies characterized by aggressive, acquisition-led, debt-reliant growth, the classic roll-up strategy.
And the two names that jump out immediately are Valent Pharmaceuticals, where he was president, and later Endo Pharmaceuticals, where he was CEO.
Big names.
Valent, of course, became infamous for combining massive debt issuance with aggressive cost-cutting and serial price hikes, a strategy that generated huge paper growth but ultimately collapsed under the weight of its own leverage.
That's the model. And we saw elements of that applied at VERO. De Silva certainly applied the cost-cutting rigor, attempting to excise unprofitable segments, which culminates in this complex hair restoration segment sale. The idea was to quickly streamline the organization to stabilize the cash burn.
But the crucial difference here is that while Valent was able to acquire and then immediately raise prices on established drug portfolios, VERO was stuck selling high-capital equipment into a competitive market with a structurally broken financing model.
Exactly. The cost-cutting failed to resolve the core problem, which was the unsustainable capital intensity of the subscription model.
So cost-cutting is just a temporary fix. It can't fix a broken business model?
No, it can't. And this failure leads us directly to the governance concerns. We have to be deeply cautious when we observe management teams who appear to prosper, or at least maintain lavish compensation, while shareholders suffer catastrophic losses.
And VERO's stock, even before this recent surge, had lost over 99% of its value from its split-adjusted highs. That is permanent capital destruction.
It really is. And a clear, undeniable signal of this fundamental corporate distress was the 1-for-11 reverse stock split they executed in March of 2025.
They did that purely to maintain compliance with NASDAQ listing rules.
Right.
Because the price had dipped below $1.
Purely for that reason. A reverse split is truly the corporate equivalent of trying to paint over rust. It's a cosmetic fix designed solely to meet optics requirements, not to generate any economic value.
Right.
Value investors view reverse splits as a severe distress signal. It confirms management's inability to fix the business fundamentally. And the fact that the stock continued to slide afterward only reinforces that it was just a desperate measure. It shows a management team focused on the technical requirements of being public, rather than the core business task of generating profit.
And now, as of January 15th, 2026, all those governance issues, they've been rendered moot by the new reality. The agency problem is now paramount.
This is the critical transition. Madryn Asset Management, the creditor, is now the owner.
So what does that mean?
With 91% ownership, Madryn's entire incentive structure has shifted. They are no longer an interested lender just hoping for the best. They are a distressed debt fund whose primary goal is maximizing their debt recovery and stopping the massive hemorrhage of cash. This means prioritizing operations that benefit Madryn, often at the expense of the minority shareholders.
And what's the biggest, most immediate cost they can cut?
Public company compliance costs. We're talking about $2 to $5 million in annual expenses, audit fees, legal fees, SEC filing preparation, investor relations, board costs.
All the baggage of being public.
All of it. For a company burning cash this quickly, eliminating that public burden is the lowest hanging fruit for Madryn to improve their internal cash flow.
And that is the motivation behind their immediate discussions with the board regarding the potential delisting and deregistration. They want to take VERO dark so they can operate it efficiently, strip out overhead, and restructure without the burden of quarterly scrutiny.
Which creates a direct and explicit conflict of interest with the remaining 9% of public minority shareholders. The market, by bidding the stock to $5.57, is assuming Madryn will pay a premium to acquire that remaining 9%.
But Madryn, on the other hand, wants to delist as cheaply as possible, ideally at or near the actual intrinsic value we calculate, which is well, less than $1.
And here's the cold reality. Madron's 91% stake renders traditional minority governance protections purely theoretical. They have enough votes to approve whatever they want, including merging VERO into a wholly owned subsidiary, or just letting the stock delist and eventually deregister entirely.
Leaving minority shareholders holding illiquid shares in a private entity. A nightmare scenario.
Exactly.
Chapter 3. Financial health.
Okay, let's anchor this whole discussion with the cold, hard numbers, because the financials are where VERO's distress is just undeniably confirmed. The income statement tells a very clear narrative of structural decline. It's a relentlessly shrinking pie that cannot support the fixed corporate cost base.
We mentioned this company was once a 100 million plus revenue player. The peak was what, 105.62 million in 2021, and that was driven by that short-lived subscription boom.
But look at the slide. 76.35 million in 2023, dropping further to 64.83 million in 2024.
And that decline continued into 2025 as they accelerated the shift to generic cash sales and exited those unprofitable international markets. The estimated 2025 revenue run rate suggests they'll fall into the $55 to $58 million range.
This isn't a cyclical dip in demand. This is a strategic, structural downsizing of about 45% over 4 years.
And the consequence of that shrinking top line, especially for a manufacturing business, is catastrophic. It's negative operating leverage.
Right. So when sales are shrinking, those unavoidable fixed costs, like the salaries of R&D engineers, the rent on manufacturing space, the expense of corporate infrastructure, they're all spread over fewer and fewer sales dollars.
So their margins get compressed even faster than the revenue is dropping.
Exactly. They just can't cut costs quickly enough to keep pace with the declining sales.
We can quantify the financial hemorrhage, too. The net loss in 2024 was a staggering negative $47 million.
$47 million. And in the third quarter of 2025 alone, the net loss was negative $22.6 million. If we look at that Q3 performance, the company essentially loses about 40 cents in net loss for every $1 of revenue it generates.
That is an unsustainable, life-threatening burn rate. No business can endure that for long.
Which leads us directly to the balance sheet, which details exactly how Madron was able to execute this takeover. This is the debt-to-equity trap. VERO was in a severe liquidity crisis, completely unable to service its obligations.
Let's put the cash position into perspective. As of September 30, 2025, they had only $5.9 million in cash and cash equivalents. I mean, you need more than that just to manage short-term payroll and inventory payments.
And against that meager cash position, they carried total debt obligations, primarily to Madron, of $30.1 million. They had absolutely no ability to pay Madron back.
Which gave Madron all the leverage to dictate the terms of their survival.
Total leverage. And the mechanism of the takeover was fascinating, and it's why the market is having such a technical reaction. It was a series of continuous debt-to-equity exchanges all through 2025.
So how did that conversion structure work?
Madron didn't use cash to buy shares, they used debt forgiveness. They swapped high-interest debt that VERO couldn't pay for instruments like the Series Y preferred stock. We saw $6.5 million swapped in July 2025, and then another $11.48 million exchanged in October 2025.
So it wasn't a sudden action, it was a slow, deliberate accumulation of control via the balance sheet.
Exactly. Madron moved from creditor to preferred shareholder, which put them ahead of the common shareholders in the capital structure.
They're preferred because they have rights superior to common stockholders.
Correct, including, crucially, the right to convert that equity into massive amounts of common stock, which is exactly what happened on January 13, 2026. The January 15th filing was just the final mathematical acknowledgement of this process, that the lender had now seized 91% of the company by forcing a massive dilution onto the remaining public common shareholders.
It's the financial equivalent of a quiet, creeping takeover. The existing owners don't realize they've been displaced until that final dilutive conversion occurs.
That's right. The common shareholder paid the price for VERO's debt obligations.
And finally, let's look at the cash flow analysis, because this confirms the broken nature of the business model. Warren Buffett looks for owner earnings, right? Free cash flow. VERO is the polar opposite of a cash generator.
Oh, it's consistently and severely negative. Cash used in operations, just running the day-to-day business, was $7.3 million in the first 9 months of 2025 alone. Year after year, VERO consumes more cash than it generates.
The capital junkie.
That's the perfect term for it. It's relying entirely on continuous external funding to survive, whether that's through Madren's debt or equity infusions.
For the value investor, this is a fundamental disqualifier. A healthy business prints cash. VERO prints losses. The financials confirm this is a business on life support, sustained only by the financial willingness of its senior creditor, Madren, to keep funding the losses until they can restructure it privately.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks each, with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Part 2, Chapters 4 to 7. Market Sentiment, Ownership Risk, and Final Conclusion. Chapter 4, Market Sentiment. The financial reality we've just detailed is, well, it's dire. Yet the stock price surged 400%. This is where we have to discuss the spectacular display of market psychology, a truly dramatic Mr. Market moment where the price completely decouples from the financial fundamentals.
The surge was immediate and it was violent. The stock opened at around $5.57, up over 400% from its previous close of $1.43 on trading volume that was just exponentially higher than normal.
And the key factor here is the market's instantaneous interpretation of the news. The news that Madren had taken control and was seeking delisting.
The interpretation was classic merger arbitrage logic, right? The thinking was, Madren wants to delist, therefore Madren must pay a fat cash premium, a squeeze-out premium, to acquire the remaining 9% of minority shareholders.
So the speculative bet was that the new owner would pay, what, $4 or $5 just to make the problem go away quickly.
That's exactly the speculative consensus, but it completely ignores the technical mechanism behind the price spike. And we need to clarify this. Madren's conversion to 91% ownership caused the free float, the total number of tradable shares in public hands, to shrink to an extremely thin sliver.
Okay, so you're saying that 91% of the shares are now locked up, which means there are almost no shares available for sale on the exchange.
Think of it like a market stall that usually sells 100 apples, but 91 of those apples have just been locked away in a safe. So when the news of delisting created this intense, sudden demand from speculators rushing to buy VERO's stock, that massive demand met near zero supply of willing sellers.
And that forced the price vertically upward in a vacuum. That's what created the $5.57 price tag.
It was a technical liquidity crisis, not a fundamental revaluation of VERO's assets. The underlying business is worth less than it was the day before. It's just that the supply of shares suddenly dried up.
This is the critical disconnect.
It is. Madren gained control through distressed debt forgiveness. They effectively paid nothing per share to the common shareholders who were diluted. So why would a Madren, whose entire mission is debt recovery and cost reduction, suddenly turn around and pay a $5.57 premium on shares they acquired for pennies on the dollar?
That's the real challenge to the speculative logic. They weren't accumulating stock on the open market at a cash premium. So the market expectation that Madren will suddenly decide to spend $10 to $20 million to clean up the last 9% at this spiked price, a price they themselves did not create, that carries substantial and potentially catastrophic risk.
The expectation is built on faulty logic. It's derived from healthy company M&A precedents. Madren is not acquiring a healthy company. They're restructuring a defunct one. Their priority is cost savings, not shareholder generosity.
Chapter 5. Ownership Structure. To understand the finality of this situation, we have to nail down the specifics of the takeover using the SEC filing itself. We're looking at Schedule 13DA, Amendment Number 12, filed on January 15, 2026. This document is the smoking gun.
That filing officially disclosed that Madren Asset Management's beneficial ownership now stood at approximately 18,763,125 shares of Venus Concept common stock.
And as you said, that represents an absolute and unchallengeable 91% of the total outstanding common stock.
It's a level of control that allows them to bypass nearly any minority opposition.
But this wasn't a sudden event. This was the culmination of financial engineering that took place over many preceding months in 2025.
Yeah.
It was that continuous cycle of debt-to-equity exchanges that enabled this takeover.
Right. Let's just clarify the mechanics of that creeping takeover through the balance sheet. Vizuro was unable to pay Madryn the $30 million it owed. So instead of demanding cash, Madryn agreed to swap chunks of that debt for a specific instrument, the Series Y preferred stock.
Which is how they swapped the $6.5 million in July and another $11.48 million in October. Essentially, they were trading their creditor status for a superior class of equity.
And crucially, Series Y preferred stock is not common stock. It carries conversion rights designed to protect the senior lender. When VERO failed to meet subsequent performance metrics or payment schedules, Madryn exercised those conversion rights on January 13, 2026. This was the decisive moment.
So what does that conversion mean for the original common shareholders who were holding the stock at $1.43?
It means massive dilution. When Madryn converted those preferred shares, they weren't buying existing shares. They were forcing the creation of millions of new common shares. They essentially printed 18 million new shares that immediately displaced the existing public shareholders, forcing them to absorb over 90% of the pain of the company's prior debt.
It's the financial equivalent of being pushed off the board entirely.
It is, and this detail is vital. Madryn didn't pay $5.57 or even $1.43 for control. They acquired control by forgiving debt that VERO couldn't pay, which resulted in the elimination of the value held by the prior common shareholders.
And the January 15th filing was just the final mathematical step, confirming the full exercise of those rights.
Exactly. And what immediately followed this decisive maneuver confirms their intentions regarding the public structure.
Madryn immediately engaged the board of directors, stating clearly their desire for the company to reduce operating costs, explicitly including the potential delisting and deregistration of the common stock.
Their intention is pure and simple. They executed a creeping takeover through the balance sheet, they secured overwhelming control, and their very next action was to initiate the process to go dark and save money. The market interpreted this as a prelude to a golden parachute. Madryn views it as necessary financial housekeeping to maximize their return on the debt they recovered.
Chapter 6. Risk Assessment. This brings us to the core of the value analysis. Risk assessment. A critical piece of the Buffett framework is the presence of a moat-resident competitive advantage. Does VERO have pricing power? Can they ward off competitors? Based on the sources, the answer is a definitive and resounding no.
Not at all. Their technology is facing rapid commoditization. VERO's MP technology is non-invasive, which means it involves less risk and quicker recovery, but it also delivers less dramatic results. And the market for non-invasive aesthetic devices is now intensely saturated.
And their competitors are moving quickly up the efficacy scale. You look at the market leader, InMode, with products like Morpheus 8, they use RF microneedling. That's a minimally invasive treatment that penetrates the skin deeper and achieves results that truly bridge the gap between simple non-invasive treatments and actual plastic surgery.
VERO's non-invasive solutions are just playing catch-up in a crowded field where the barriers to entry, the cost and complexity of manufacturing these laser and RF diode systems are now remarkably low. Any competitor with sufficient capital can bring a comparable machine to market.
And on top of that, they lack the second critical type of moat, a powerful brand moat. The most successful aesthetic companies, they build patient pull. Patients walk into a clinic demanding a specific brand name. I want cool sculpting. I need Botox.
VERO has none of that.
None. Their strategy was always B2B, selling the economic benefit of the subscription model to the provider. The machine was a tool to help the clinic get started. Now that the subscription model is collapsing and VERO is selling machines outright, providers just view a Venus machine as an interchangeable tool. It's no different from any other mid-range laser device.
So they're easily substituted, which completely eliminates VERO's pricing power.
Right. And beyond the lack of an economic moat, VERO faces these structural costs and geopolitical risks that put it at a significant disadvantage compared to its peers, even profitable ones.
Supply chain is a major factor detailed in their SEC filings. A substantial portion of VERO's manufacturing and supply chain remains based in Israel. And management has explicitly cited the ongoing regional conflict as a cause for supply disruptions, increased logistics costs, and, crucially, reduced efficiency.
All of which erode gross margins that are already under pressure from that negative operating leverage we talked about.
And then there's the issue of tariffs, compounding the problem. VERO noted that U.S. tariffs on imported medical devices sourced from Israel led to modest margin erosion. They're structurally disadvantaged by paying a penalty to bring their goods into their largest market, unlike peers who may manufacture domestically or source from tariff-exempt zones.
These are tiny cracks. But in a distressed business, tiny cracks cause the entire structure to collapse.
You can see this competitive disadvantage reflected violently in the quantitative data, our competitive scorecard against industry peers like InMode, INMD, and even other distressed players like Cutera, CUTR.
The contrast is horrifying. I mean, InMode maintains strong growth, massive free cash flow, and a positive net margin, often near 40%. VERO, by contrast, operates with a severe negative net margin of negative 92.76%.
That is not a business. That is a subsidized operation. And look at the return on equity, which measures how effectively management uses shareholder capital. VERO's is a catastrophic negative 794%.
These are not the metrics of a defensible, stable business. They're the metrics of a value-destroying operation on the verge of bankruptcy.
And that brings us to the most crucial point, valuation risk. This is why the $5.57 price spike is so fundamentally dangerous. We have to calculate the intrinsic value to prove that the market price is just utterly unfounded.
So what are the scenarios?
Well, we have to consider the three core valuation scenarios. First, the going concern model, specifically a discounted cash flow, a DCF. But since the company has consistently negative free cash flow and estimated negative growth rate, we expect negative 10 to 15% annually due to that strategic shrinkage and an extremely high cost of capital because of the obvious distress. Any mathematically rigorous DCF model must yield a negative value.
So the business destroys value every single year it operates.
Correct. So if the business is worth less than zero as an ongoing concern, we move to scenario 2, liquidation value, the old Benjamin Graham net-net. What could the company sell its assets for versus what it owes its senior creditors? We have to be optimistic here and assume the critical $20 million hair business sale to MHG actually closes, which is a big assumption given the court involvement. Even then, total realizable assets cash, accounts receivable, much of which is slow-paying customers from the old subscription model, and inventory might optimistically reach $43 million.
And what are the claims against those assets?
Total senior claims, the $30.1 million in debt owed to Madryn, plus accounts payable and accrued liabilities, they stand around $55 million.
Oh.
So when you net those two figures, the net liquidation value is calculated as a resounding negative $12 million. Common equity is entirely out of the money. If VR were forced into bankruptcy tomorrow, the common stock should mathematically trade at zero or be completely wiped out.
Yet the price on January 16th was $5.57. That implies a market capitalization of $115 million and an enterprise value, or EV, of $139 million once you factor in the $30 million in debt.
And that implies an absurd valuation multiple. If we divide that $139 million enterprise value by the estimated 2025 revenue run rate of $55 million, we get an EV to revenue multiple of approximately 2.5.
And why is that number absurd?
Because InMode, the sector leader, which is profitable, debt-free, and growing trades at about 2.7 times sales. Venus Concept, which is shrinking, destroying cash, and drowning in debt, is being valued by the market at virtually the same multiple as the market leader. This is total financial insanity.
It makes no sense.
None. If we were to value VERO rationally, using multiples from truly distressed peers like Cutera, which also faces steep challenges and trades below one-time sales, a realistic enterprise value for VERO might be closer to $30 or $40 million.
Okay, so if we take that realistic EV of, say, $40 million and we subtract the $30 million in debt owed to Madryn, the realistic equity value for the common shareholders is only $10 million.
And divided over the approximately 20.6 million post-conversion shares, the calculated realistic intrinsic value is approximately 50 cents per share. The $5.57 market price is a 1,000% premium driven entirely by a technical supply-demand anomaly and speculative hope. Madryn has zero financial incentive to pay that speculative price.
Chapter 7. Conclusion. We have to return to Warren Buffett's most important axiom here: be fearful when others are greedy. On January 16, 2026, the market is exhibiting extreme uninformed greed regarding Venus Concept. That 400% surge is not a recovery. It is a technical mirage that is blinding investors to the underlying rot.
Let's summarize this analysis using the disciplined value investors checklist. First, does VERO have a moat? No, there is no durable competitive advantage and the technology is commoditized.
Okay.
Second, is the management rational and aligned with public shareholders? The track record is one of severe value destruction, and the current controller, Madryn, has interests that directly conflict with the remaining public shareholders. They want cost reduction, not a premium buyout.
And third, and most importantly, is there a margin of safety?
Absolutely non-existent. The stock is trading at a massive 1,000% premium to its realistic intrinsic value of 50 cents per share, and a massive premium to its liquidation value, which we calculate as being negative $12 million.
VERO is the very definition of a value trap. It looked deceptively cheap at the old $1.43 price because of its high-ish revenue number, but it was expensive because of its debt and staggering losses. At $5.57, it is exponentially and dangerously overvalued.
That's right. The delisting is simply the final logical act of a corporate restructuring by the senior lender.
This event is not a prelude to a guaranteed payday for minority shareholders who are hoping for a quick premium squeeze-out. This is a creditor seizing control and preparing to close the company's extensive public chapter. The action for the disciplined investor, following the sources and the principles of value, is abundantly clear: avoidance.
The risk of permanent capital loss far outweighs the potential technical speculative upside. It's a technical anomaly, not an investment opportunity. It's a gambling chip dressed up in a financial headline.
Well said. Now, here's a final provocative thought for you to consider as you digest this analysis. We based our liquidation valuation on the optimistic assumption that the critical pending $20 million sale of the hair business to Meta Healthcare Group actually closes.
Right. And what happens to the financial picture if that sale collapses entirely? Remember, VERO has already had to seek court assistance just to compel the closing, which indicates serious friction.
So if that $20 million cash bridge vanishes,
the already negative $12 million net liquidation value would drop even further, perhaps to negative $32 million.
that would accelerate the need for immediate drastic financial restructuring that would surely wipe out the common shareholder equity completely and confirm the zero-value thesis. That is the immediate, critical, and unaddressed risk hanging over VERO's future, even after this massive surge.
Like and subscribe to Stock Analytics AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai.
For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify.
Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours.
Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings.
Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust.
Remember, this deep dive is expert research based on AI analysis of public filings and source material. It is not financial advice and should never be taken as a recommendation to buy or sell any security. Always conduct your own due diligence.
Until the next deep dive, happy investing.